In the name of God, the most merciful, the most beneficent. And today's lecture, we are continuing with chapter B, section 2, long-term financial management, and in this, about financial instrument, debt financing, that is for bonds. So in this part that we are covering the second part of the bonds at an advanced level, and we discuss about the term structure of interest rates, that is the yield curve, and value of bonds, duration as a measure of bond, interest rate sensitivity, impact of income tax on bonds related financial decisions. These are the basic features of bond that we studied in the previous lecture, and we are now starting with the market situations and the yield curve, and then we go to proceed for the bond valuation calculation. A bond is a debt instrument, a kind of loan issued by the corporate companies or government for a period of more than 1 year. Usually, bonds may be bought on a short-term bonds, that is 2 to 5 years. Medium term can be called as intermediate bonds, 5 to 10 years duration, and long-term bonds 10 to 30 years. The investors acquiring a bond earns interest by lending money, because the return is not profit, it is interest. That's why it is called debt financing. The bondholder are not shareholders, and they are like creditor or lender. The issuer of bond, that means the corporate company or the government, are to be called as the borrower in this sense of debt financing. They get needed capital, cash flow. So here is the diagram. It shows the relationship between the investor and the corporate company who are called as bond issuer. It can be a government or company. So the bond issuer, they need debt financing. They determine in accordance with their capital structure need for funding their assets. So they issue bonds, and the investors who see in the market and they want to contribute or invest their money in these bonds, so they send the flow cash to the corporate, and it will go as a capital, and it can be regarded as a loan. But in return, as a reward for this capital, this debt, so the bond issuing company pay back the interest, periodical interest, regularly to the investors, and they are called coupons. The par value or the face value of a bond is the amount that the bond issuer has borrowed from the investor. So that's the bond, that will be the par value or face value, and the total sum that the investor pays to the bond issuer will be multiplied by the number of bonds certificate, number of bonds multiplied to the face value or the purchase price, that we will see in detail later. The fixed rate of interest, that is called coupon rate, to be paid by the bond issuer to the investor, and that can be multiplied by the par value of the bond on the rate of the coupon rate. For example, if coupon rate is 3%, par value is 10 lakhs, and so the 3% means for this 10 lakh worth of total bond value will be 30,000 annual interest payment. So that's how the calculation. So fixed income, when we say fixed income, the amount received in coupons at regular intervals is the investor's fixed income per year. So they get by way of coupons. Sometimes, in most of the American companies, the coupons are semi-annual. So, for example, if there is a 6% per annum interest rate and 6 months coupon, they will get 3% of the on the par value. So 6 months 3%, another 6 months 3%, so total becomes 6% per annum. So this is how this calculation has to be done. And bonds are typically tradable. Okay, as market prices vary from the par value, the current yield of a bond is the annual interest payments of the bond divided by the bond's current market price. So how it is to be calculated, and all these things will be studied in this lecture in detail. Okay, and there are various types of bonds. All these things we will be studying in detail. So let's understand the yield curve. That is the term structure of interest rates is called. It's reflected in the graphical representation is the yield curve. So it is interest rate over time. So that's the idea. It is actually the relationship between an interest rate and the time to maturity. The time factor. Okay. Yield curve on a graph with the rate of return on the vertical axis. So that's the rate of return on the vertical axis, and the time factor, the years to maturity, on the horizontal axis illustrate the common yield curve. And there are 4 type of common yield curves that you can see. Okay, so they are like upward sloping and flat and downward sloping, and there is a hump. So these are the things. What is that meaning? So we will see one by one based on the characteristics of these curves. When plotting a yield curve, first of all we should understand, basically when we do these things in this study, in the yield curve study and all these things, there are some kind of basic assumptions. Based on these assumptions only, these curves are represented in the economic view. So when plotting a yield curve, several factors are held constant. Like in economic theory, all other things being equal or remain constant. So like that, we should understand that the default risk of instruments remain constant. As if that when you compare so many instruments, we assume that all have no default risk. And then put into the graph to see whether it is upward or downward or flat or humped. So we can see like that. So like that, the taxability of the instrument also remains same. And callability of the instrument, like if there is a call provision that the issuer can take call back, so that is also remains same, constant for all these things. And sinking fund provision, if the company has a sinking fund, that we will see in detail. So all these things are basic assumption, assumed that they are remain constant. Corporate treasurers use the term structure to decide whether to borrow short-term debt or long-term debt. So they decide based on this kind of graphical study. Investors, on the other side, use the term structure to decide whether to buy short-term or long-term bonds. Like corporate sectors, corporations who are issuing the bonds, though their aim and objective is different based on this, and exactly opposite view is the investor's view. Okay, so that is the thing that you should understand. So this table is very important table that for the students from the examination point of view, it shows the characteristics of the slope of the yield curve and what are the interpretation on that. So you have to a little bit read it carefully and memorize it so that you can at least 1 or 2 questions will be based on this. Why I am saying this thing, because in the exam hall you don't have time to think about it. So it's better to know by heart. So the slope of the yield curve says the market's expectation about interest rates. So the slope of the yield curve, and from the long-term interest rates versus short-term interest rates, what is the behavior? And if there is any remarks on that, how do you interpret them? So if it is upward sloping, that is normal slope. So the long-term yield is greater than the short-term yield. That signals that the economy is in an expansionary mode. It's good. The downward sloping, that is inverted slope, that means the long-term yield is less than the short-term yield. It signifies that the economy is in or about to enter a recessive period. A recession is going to appear. So that is the danger thing. Okay. Flat yield curve means very little variation between long term and short term. There is no big difference between these things. It remains flat. Signals that the market is unsure about the future direction of the economy. If the market expects that interest rates will not change much in the future, so it will show a flat curve, flat yield curve. Humped yield curve. Long-term yield will about the same as short-term yield in the initial, and in the middle it will be little bit higher. Okay, the medium-term rates will be slightly higher, and then again go to flat. So that's the idea. As expectations change from increasing rates to decreasing rates, the yield curve of the humped yield curve may pass through a period where it is humped or raised in the middle. So only in the middle it is expected to be raised. So that's why it is the hump shape. Okay, CMA adapted question. If the term structure of interest rates, we know that means we are talking about yield curve, has an inverted slope, what does this imply about long-term interest rates compared to short-term interest rates? So a long-term rates are lower than short-term rates, which is option A is the right one. Why? Because the downward sloping, which is the inverted slope, that is the downward sloping, it is long-term yields is less than the short-term yields. It signifies the recessive period. Okay, so that is the idea. Actually, inverted slopes are not common, but appear to show when there is a recession. Okay. Another question. The yield curve depicting the term structure of interest rates holds that the default risk constant is usually downward sloping, never changes the slope, shows the relationship between inflation and years to maturity. So the right answer holds the default risk constant. The yield curve depicting the term structure of interest rates holds the default risk constant, because as we studied earlier, there are certain assumptions that they are remain constant. Okay, so the default risk is and inflation factors, seeking fund provisions and call provisions are remain constant. So this is one of the things. All others are not actually the yield curve depicting the term structure of interest rate, not related to that. The yield curve graphically depicts the relationship between interest rates and years to maturity. That we know that. When plotting a yield curve, several factors are held constant. So these include default risk, taxability, callability, and seeking fund provision that we studied. So option A is valid, it's correct. So why answer B, C, and D are wrong? We can see answer B is incorrect because historically most long-term rates have been above short-term rates. Actually, B says usually downward sloping, so it is not like that. So it is the long-term will be always upward. Most of the cases it will be the upward sloping. So that's why B is wrong. And C says never changes the slope. So that is also not right, because the yield curve changes over time in position and slope also, because this is a market. Okay, yield curve. And D also wrong. Why? Because it shows the relationship between inflation and years to maturity. We know that the yield curve theory is not about inflation, it is about the interest rate. Okay, it is not about inflation rates, it is about interest rates. So therefore D also wrong. So only thing A holds true because it is the constant, the assumed constant for this theory. Okay. The calculation for the nominal yield on a debt security. So what is that formula? This formula to make this calculation is, so the yield of treasury security with same term, and in which you have to add the default premium and also add any liquidity premium, and you have to adjust it plus or minus for the premium. If it is premium, you add it. If it is on discount, you minus it for tax status, and if it is premium, you add it or discount it for special provisions. Therefore, you get the yield of debt security. We calculate the nominal yield on a debt security by starting with the risk-free rate. So first we take the US Treasury bill kind of risk-free rate, and then we move on this kind of formula calculation. So, as the total or the appropriate yield is a nominal rate which contains an inflation premium, we convert a nominal rate to a real rate. So, it has got some impact on the inflation. So, that we have to smoothen it, eliminate it. So, how do you calculate that? In order to have the real rate to a real yield. So, what is that nominal rate? So, that is a thing. In order to convert it, you have to adjust for the inflation rate. For this conversion, we use the following formula: 1 plus nominal rate divided by 1 plus inflation rate, and then minus 1. So actually we know that inflation eats into the return of a bond. Okay, from the return there is also, because we may see the figure is good, but maybe there is kind of increase is due to inflation also. So you have to adjust that inflation rate, then only you can get the actually whether the bond is performing a better rate or not. If your bond's return is more than the inflation rate, okay, then the bond produces a positive return. Else, if it is not more than the inflation rate itself, that means it is poorly performing. It is not attractive. It is less than the inflation rate. That means the bond produces a negative return. It means it's a loss. Okay, so that is the important point. For example, if a bond's return is 6% and inflation itself is 4%, so the bond produces a 2% real return. But if your bond's return is 6% and inflation is 8%, so the bond produces a -2 real return. So that's how you have to understand. So what are the 4 major theories that attempt to explain the slopes of yield curve? We saw the yield curve. There are 4 major theories which attempt to explain. There are pure expectations theory. It is about the shape of the yield curve is determined by expectation in the market of future interest rates. So that we will see in little detail more also. And then liquidity preference theory. That means if investors increase the risk by holding long-term bonds, they will require higher compensation. Okay, higher interest rate. If there is a higher risk, they will return the return also. The expectation for the return also will be higher. That is the behavior of the investors. Okay, for assuming that because they are taking more risk, so they expect more return. The segmented markets theory is based on focusing on cash needs of different groups of investors and borrowers. Each group chooses securities that meet its forecasted cash needs. So there will be different people for the different angle they will view their cash needs and their risk attitude. Accordingly, they will measure it. That can be segmented, and accordingly we can study it. So the preferred habitat theory, a compromise combining the elements of the segmented markets theory and the pure expectation theory. So it is a combination of both. In little further detail to know about pure expectation theory. So expectation theory predicts future short-term interest rates based on current long-term interest rates. To understand it, let's see an example. If the present bond market provides investors with a 2-year bond that pays an interest rate of 20%, while a 1-year bond pays an interest rate of 18%. Using this expectation theory, we can calculate to forecast the interest rate of a future 1-year bond. The theory suggests that an investor earns the same amount of interest by investing in two consecutive 1-year bond investment versus investing in one 2-year bond. So that's the difference. So like whether to invest in 1-year bond and for 2 consecutive years, or just right away to invest in one 2-year bond today. So that's the idea. And if we calculate that, almost this theory suggests that the amount they earn will be the same. In this theory, the long-term rates can be used to indicate where rates of short-term bonds will trade in the future. Going in further detail for the liquidity preference theory, we can understand that liquidity preference theory refers to money demand as measured through liquidity. In real world terms, the more quickly an asset can be converted into currency, the more liquid it becomes. So, therefore, it is much preferred when all the return or the reward are same. But the market and also the profit maximization interest of the investors, so it can be varying by taking risk or depending on their risk attitude. The theory suggests that investors demand progressively higher premiums on medium and long term securities as opposed to short term securities. That's explaining why they are progressively higher premiums they are demanding on that, because of this liquidity concept. For example, a 3-year treasury note might pay a 2% interest rate, whereas a 10-year treasury note might pay a 4% interest rate, because the longer the duration, the return reward will be more. And a 30-year treasury bond might pay a 6% interest rate. For the investor to sacrifice liquidity, they must receive a higher rate of return. That's a concept. They must receive a higher rate of return in exchange for agreeing to have the cash tied up for a longer period of time, because their liquidity expectations are tied up, their cash are tied up in the investment for having a long-term maturity. That's the idea. Here's one example for calculating the forward rate of return based on the given information for 1 year, 2 year, 3 year, 4 year, the time period for which the forward rates for first year, second year, third year are given, and for fourth year we have to find out based on the spot rate are already given for all the 4 years. So how do we calculate? This is just to explain you the simple formula in order to calculate forward rates, or from this given table any missing one particular information we can easily calculate how it is. So to solve this, we need to multiply the 2.5% fixed rate, that is the spot rate, for a 4th year security by 4 years, and then subtract from the product of the previous, that is the 3rd year spot rate, by 3 times, and then minus it. So you get the actual forward rate for the year 4. That's how that difference. So that's the formula that gives. So what you should do is you take first the 4th year, the spot rate, and then multiply by 4 years, that is 10%. And then you take the immediate 3rd year one, and so 3 years you get 6.75. So if you subtract that, you get for the 4th year forward rate is 3.25. So if you put 3.25, you can cross check that by summing up and divide by 4, you get 2.5. So that's what you get. 150, 250, 2.75, 325 divided by 4, you get 250. So this is how easily the calculation is there. The US budget deficit and the yield curve. So how you have to understand a little bit about this, the relationship of that. The US Treasury makes decisions about financing the deficit that impact the term structure of interest rate, because US Treasury is also calculating their financing their deficit, and accordingly they fix also the rate. So it will have an impact on the term structure of interest rates. It determines the composition of its short-term and long-term debt, which affect the supply of securities with various maturities and thus the yield curve. The effects of its actions on interest rates can, in turn, trigger changes in demand. For instance, if the Treasury uses mostly long-term debt, for example, its demand will cause long-term rates to increase. This in turn will cause corporations to reduce their use of long-term debt by reducing their investment in the fixed assets. So because the rate increasing, so they would tend to reduce that long-term capital structure need. So maybe they will go for short-term funds which will be cheaper for that time being until the market is corrected. Or the opposite could occur in the Treasury uses mostly short-term debt. Long-term rates will be lower because of the reduced demand for long-term borrowings, causing corporations to increase their investment on fixed assets. Because if the long-term rates are less, so corporations will think of taking long-term debt so that to strengthen the fixed assets, expansion and other plans also. So uses of the yield curve. So to make forecasts and decisions, these yield curves are mostly useful. To forecast interest rates, that is upward sloping, if it is upward sloping, higher interest rates are expected, while downward means the opposite. So accordingly, they can see if the market is interest rates are high or less. So accordingly, they can adjust to the market or maintain their capital structure. To forecast the recessions also, we know that if it is an inverted curve, inverted relationship, or if it is slope downward, there is historical evidence that flat or inverted yield curves have been followed by recessions in the past. Okay, so these things are there. So they can understand the recessions accordingly, what actions that they have to take. They have to be careful on that. Their investment decisions also. And to make financing decisions also. There are corporations who have funds which they need to also put into some investment decision, as well as they need also financing, so they have to take financing decision also. Example, planning a bond issue, whether to issue that bond and what rate we can fix. We estimate the rates with different maturities, if it is giving a short-term maturity or medium-term, long-term maturity, accordingly, so they have to determine that. So increases in interest rates affect bonds and stocks, causing the stock and bond prices to decline. So if the interest rates increasing, it will cause the bonds and stock rate decline. Okay, if the interest rates declining, then stock and bond rates will go upward, increasing. So to see in detail, if you study about the forecast interest rates, so we saw that upward sloping, that is the higher interest rates are expected, while downward means the opposite. While interpreting this, we must keep in mind that there could also be liquidity preferences and specific maturity preferences at work. For example, just because the interest rates are cheaper, we cannot go to debt financing more and more. If already there are some liquidity preferences, that also need to be there. If there is a credit worthiness also, the investor will think about that also. Okay, for example, if market is high for the interest, and it doesn't mean that the investors will come on that. They have to see the liquidity, how long they can uh, avoid keeping that fund. Keep waiting for that fund to come back, return back. Okay, so that is important. So that is affecting their liquidity preferences. So it depends on the specific maturity preferences at work. And if also for the corporates issuing bond also, it is depending. If the liquidity is having a problem, that they have to think about that also. If it is in the very short period, if the liquidity is expected, so that is also the problem for them. If investors have their own interest rate projections, they can compare them to the projections implied by the yield curve and may be able to capitalize on any differences they detect. So if they have their own projections, not about the market or their own calculation, accordingly, they can compare the yield curve. If the yield curve is upward sloping, indicating a market expectations of increasing rates, investors expecting interest rates to remain the same would invest in long-term securities. Okay, so that is the idea. The investors will, for the long-term gain, they will be prepared to invest on that because they would view the long-term securities as undervalued. So it will be pick up. And to forecast recessions, okay, so we know already, we studied already inverted yield curve. It is like these kind of things. So to forecast recession, some people believe that a flat or inverted yield curve forecasts a recession because the yield curves reflect the market's expectations of lower interest rates. So there can be a recession. There is a historical evidence that flat or inverted yield curve have been followed by recession in the past. That we have to be. There are many questions on this, so students need to be careful on that. And to make investment decisions, any investor, if an investor has funds to invest for only that is the important point, you have to consider that. If they have funds to invest for a short period of time, he may purchase longer term securities. Okay, since the secondary market will allow him to sell the longer term securities when he needs the funds. So in the primary market will be he buy that, and then in the secondary market he can sell it when he needs the fund back. Because the long term securities are yielding better return than the short term securities. So this strategy is called riding the yield curve. So we are riding the yield curve. So this is one kind of investment decisions. Another part is that if the yield curve is upward sloping and 1 year securities are yielding 4%, while 10-year securities are yielding 6%. Okay, an investor could invest in the 10-year securities with funds available for only 1 year. So what he will do is he will invest in 10-year securities, and then after 1 year when he wants, he will go to the secondary market and sell it. So that at least he get that for 1 year, the return is good. The investor will receive 2% more than he could have earned. So that is the idea, because 6% is the yielding and 4% is the for the short term yield. So he get 2% more than he could have earned on the 1 year security if he go for short term security. So that is how an investor have to take decision, not just by taking into consideration about his own need of time, which is only 1 year, but you have to see the return and compare that what is the short term yield and what is the long term yield, and how much time that he has. Accordingly, he has to calculate this kind of rational decision. And to make financing decisions, like corporates when they want to issue, because they need financing, So the yield curve can be used by companies that are planning a bond issue to estimate the rates they will need to pay on bonds with different maturities. By doing this, they may be able to make a better decision about what maturity to use for the bonds they issue. The short-term interest rates have ordinarily been lower than long-term rates, so that we know already. One reason is that less risk is involved in the short run. Moreover, future expectations concerning interest rates affect the term structure. Most economics believe that a long-term interest rate is an average of the future expected short-term interest rates. That is this is one of the key points I want to mention that, and it's part of also many multiple choice questions of CMA and CPA adapted. So students should remember these things. Future inflation is also incorporated into this relationship. There are kind of part of the inflation of impact also there. Though the yield curve is nothing to read about the inflation, because inflation remains constant for the theory, but actually for the interest rate, the inflation also playing a role on that. So you should adjust it for that. You should understand before that. Investors in an uncertain world will accept lower rates on short-term investments because of their greater liquidity, because it has got greater liquidity, whereas business debtors often prefer to pay higher rates on long-term debt to avoid the hazards of short-term maturities. Because the corporates, they prefer to give a little higher rate in order to avoid liquidity crisis in the short term. So that is the idea. Because they have to finance their fixed assets maybe for the long term basis. So they may not have cash flow to settle it in the short term. So they will accept that much little higher rate because to avoid that liquidity risk. So that is the idea of that. Okay, let's see one multiple choice question. So the yield curve shown in this diagrammatically here, it implies that the credit risk premium of corporate bonds has increased, or credit risk premium of municipal bonds has increased. Long-term interest rates have a higher annualized yield than short-term rates. Short-term interest rates have a higher annualized yield than long-term rates. So the answer to these questions is that here we know that from the yield curve is about the interest rate to time. So the option A and B are not valid answer, but C and D are here. That answer C is correct. Why? Because we know that most of the cases the long-term interest rates have a higher annualized yield than short-term rates. So that's the correct answer. Okay, because this relationship is depicting an yield curve. Assuming the long-term interest rates is an average of expected future short-term rates, the curve will be upward sloping when future short-term interest rates are expected to rise. Furthermore, the normal expectation is for long-term investments to pay higher rates because of the higher risk. Thus, long-term interest rates have a higher annualized yield than short-term rates. Why A and B are wrong? Because the yield curve does not reflect the credit risk premium of bonds. That we should understand. And D is incorrect because long-term interest rates should be higher than the short-term rates, not lower than. Okay, how is the selling price of a bond calculated? The selling price of a bond, any bond, is calculated by determining the present value of all the future cash flows of the bond. When we say future cash flows, it will be the coupon values that we keep on the investors are receiving. So that is the thing, like interest 6 months or 1 year. So how many, and based on that, how many year that bond will remain, and they will yield. So that you add it together and you have to take the present value of them plus the final return value, that is the face value of the bond, the repayment of the face value at the maturity. So for both, you have to take the present value, add up together, you get the selling price of any bonds actual value you can calculate. So there are two cash flows that are relevant to this process. Exactly, it is the sum of the cash flows. So what are the cash flows? One is that each of the interest payments, that means each of the coupon payments, and the repayment of the face amount of maturity. But for all these things, because we are getting these payments in the future, so but we are calculating today, so we have to calculate the present value. That's simply to understand that. This discount, how do we calculate the present value? By discounting to the present value is done using the market rate of interest for bonds with similar characteristics. That means the same maturity, default risk, terms and conditions, etc. So you can see the present value table for these kind of things. Given a rate of interest, given the number of years maturity, so if we get from this table the present value for each dollar, so accordingly you multiply that, the cash flow that you are calculating, you get that answer. The market rate is used because this is the rate of the investment alternatives available and is therefore the mean like kind of opportunity cost. So you take from the market rate, and therefore the minimum return that an investor would require will be this market rate. What is the bond discount? So bond selling at a discount means that the bond's selling price is less than the face value of it. So it is like a discounting check or things like that. The situation arises when the market rate of interest is higher than the interest rate that is stated on the bond. Okay. Then if the bond, because if the market rate of interest available is higher than the bond's interest rate, normally people won't prefer to buy this bond. They will be interested to invest or else where there is the financial instrument that is equivalent to or higher than the market rate. So that is the rational decision that they will have. So in order to sell this bond in the market, so they have to put it a discount value of this bond. So then only it will be equate. If the bonds were sold at its face value, nobody would buy the bond because they can receive a larger return from another bond in the marketplace. So the investors will go for that. So by reducing the selling price of the bond, but not the amount of interest that is actually paid each period, because the amount of interest is paid on the face value of the bond, not the discounted value of the bond. So that is to be, and also at the redemption time upon maturity, the face value of the bond will be returned. So the effective interest rate of the bond becomes equal to the market rate of interest because of this discount. For example, a bond with a par value of $1,000 that is trading at $980, which means $20 discount, as a bond discount of $20. Besides any stated interest coupons, the maturity value of the bond will be $1,000 only upon the maturity. Different bonds trade at a discount for different reasons. For example, bonds on the secondary market with fixed coupons trade at discounts when interest rates rise. So that is also there. While zero coupon bonds, short-term bonds are often issued at a bond discount when supply exceeds demand. Zero coupon bonds means there will be no interest paid, but the effect of that kind of reward will be discounted from at the time of selling. So upon maturity, the bond will be returned to the face value, bond value will be returned to the face value, so that the buying time it is a discounted purchase, so that difference equate the expected return on that bond by way of interest. What is the bond premium? That's just opposite to the discount. Bond selling at a premium means that the bond selling price higher than the face value of it. A premium bond is a bond trading above its face value, or we can say that for the investor it costs more than the face amount of the bond, because it has to be purchased a slight premium. A bond might trade at a premium because its interest rate is higher than the current market interest rates. So many people will be, the demand for this kind of bond will be increasing, but supply is for that is whatever this thing. So the demand increase, so automatically the price also increase because it is providing higher interest rate than the market. The company's credit rating and the bonds credit rating can also push the bonds price higher because this is the risk based market. So actually, people wanted to invest conservative decision makers. So they will like to see the companies that is issuing the bond and or the bonds credit rating should be better. So then only it can push for purchase of that bonds. Thus, it will increase the price also because the demand increase. Investors are willing to pay more for a credit-worthy bonds. So that is the idea from the financially viable issuer. Either for more return or for less risk, and also depends on the risk-reward attitude. The investors, they are the investors' rational decision making works in that dynamic approach. So accordingly, this whether it is bond will be issued at discount or premium, things will be decided. Let's see this CMA adapted exam questions, which is available in the book also. H company needs to raise $15 million for its research and development program. Its investment banker suggested raising the funds through the issuance of original issue discount bonds. Okay, so they are suggesting discount bonds. The bonds would be outstanding for 5 years, so it will be 5-year maturity. It will have a semi-annual coupon rate of 6%. So that means for $1,000 each, semi-annual coupon rate at 6%, meaning so 6% on 1,000 is 60, but it will be paid semi-annually. So $30 for the $30 for the first 6 months, and then the next 6 months $30. So like that, the interest will be paid. The current market conditions require a yield of 8%. That is the expected return on the market condition. Given H company's bond rating, so because of this rating, so this 8% expected return is possible. H company's marginal income tax rate is 40%. So income tax rate is 40%. So bond has an interest, so it is also have a tax benefit. Okay, so that we have to keep it in mind. Ignore the issue expense of the bonds. Okay, we don't consider for this purpose of this exam question. So we just ignore or treat that the flotation cost is 0. Okay, we just ignore and assume the bonds are issued. Okay, so now our questions: what is the issue price of each bond? Show your calculations. So what is the issue price? The face value, we know that it is $1,000 each, but we might discount it. So what will be the issue price? What is the discount amount per bond? So if we know the issue price, we can calculate what is the discount price and how many bonds to be issued. In order to have in order to raise the fund of $15 million for the asset of R&D program, so how many bonds, how many numbers has to be issued? We can't just $15 million divide by $1,000 bond. We cannot do that because we are issuing it at discount. So we get the cash flow a little less. So we have to find out the issue price of the bond, then divide the 15 million by that. Then only we can know how many bonds to be issued. So this is the, given this question, the solution is that simply what we need to find is the expected, the present value of the expected final payment for this bond, because when we calculate the present value means we have to discount it. Finally, after 5 years maturity, that we will get $1,000. Yes, but the present value of that $1,000 which we may get after 5 years need to be discounted in order to get the present value, and for that the required yield rate will be take it, the market according to the market condition, which is given as 8%. So we have to calculate the present value of $1,000 in 5 years at 8% compounded semi-annually. So we have to get it dollar that we from the present value table we get this value per dollar. So when we multiply that, so we will actually the present value of that $1,000 that we will get after 5 years at the rate of discount rate of 8%. So that will be $676. Plus we will be getting semi-annually the interest at the rate of 6%, which will be the coupon rate for 6 months, every 6 months, that will be $30. And for that, the value, present value table, you can get it 8.111. So when we multiply that, it will be 243.33, because this is a 5-year accumulated present value for that $30. So that will be 243.33. So actual the return for this investor will be the 676, that finally we may get the present value of the final payment that we get, and also the continuing the coupons, interest coupons, the present value of the total is 243. So the net present value of the net cash flow, the total cash flow in return will be getting, but for the investor will be 919.33. So therefore, if we take the face value, deduct by the price of the bond after the discount, so we get the discount value $80.67. So we know the price, the discounted price. With that, if we divide the 15 million, we get 16,316 bonds. We'll have to get it. Bond valuation. The value of your bond is the sum of its discounted cash flows. So basically, we calculate the present value of the future cash inflow for the bonds. Like for example, the discount rate used is the market rate of interest, and it can be also called like effective rate, the yield rate, or the required rate of return. So using this required rate of return or the market rate, the steps to determine the value of your bond are: first we calculate the present value of all the interest payments at the market rate. So we use the present value table using the maturity aspects and the rate of interest. So we get the present value for $1 and multiply that with the total cash flow that we get for the interest payments. And then similarly, we calculate the present value of the face value of the market rate, as if that we get on the maturity date the redemption of the bond. And adding these two sums of the present values, so that we get the present value of total proceeds discounted at the market rate of return. So this is how we find the valuation of the bond. Example: January 1, year 1, a firm issues 100 bonds with a face amount of $1,000, maturing in 5 years and bearing 6% annual interest. At the time the bonds are issued, the interest rate prevailing in the market rate is 8%. That is the expected rate. The proceeds received by the issuer can be calculated as follows. So how can we do that? So we first get the present value of a single payment of $100,000 discounted at 8%, which is the market rate, for 5 years, because 5 years is the maturity. So we get the present from the present value table, 0.68058 is per dollar. So when we multiply that for the return value, for the redemption value of that $100,000. That is 100 bonds multiplied by 1,000. So it is come to $68,000, $68,058. And we have to take present value of an ordinary annuity of 6,000 discounted 8% for 5 years. What does this mean? So we are told that 6% interest bearing annual, so that for 5 years. So we have to take the annuity table for present value calculation, and we get the value of 3.99271, which has to be multiplied by 6,000 is the amount paid every year per annum. So that is $23,956. So the total proceeds $92,014 is the present value total sum, which is the value of the bond. But actual face value is $100,000. So the difference between these two things should be treated as a kind of discount. So that has to be calculated. Whether based on this calculation only, then we find the valuation of the bond. So accordingly, whether this bond has to be sold at discount or not, how the investor will take it forward, all these things will be determined. Another question: what is the price of a 10-year 10% coupon bond with a $1,000 face value if investors require a 12% return? Assume annual coupon payments. So how do we calculate this? So we have given this is the 10-year maturity and face value is $1,000 and 10% coupon bond. So expected annual return is 12%. Market return is 12%. So to solve this question, we have to calculate that the present value of the bond is equal to the sum of present value of the face value of the bond and the present value of the interest payments. And using in the present value table, so we can achieve this result. So what we do is that first we take the $1,000 at the rate of 12% is the required rate of return, market rate of return. So for 10 years, so we take present value table the figure per dollar. So we multiply and we get $322. And then we take all the sum of all the interest payments for 10 years at the market rate 8% for $100. $100 how we come? Because the face value is $1,000 and 10% is the coupon rate. And coupon rate is given per annum basis, annual coupon payment. So we take $100 and at the market rate of return 8% for 10 years. So we achieve that is $565. The total become $887. This is the value of the bond, because today's the face value is $1,000, but we get after 10 years. So actual present value of that $1,000 after 10 years is only $322 according to the 12% expected return. And similarly, all the interest payment together, we get that using the present value table from the annuity table. So we get $565. So it is $887. That's the thing. Other options are wrong. Why? Because they are ignoring the present value tables. And this one is option C is calculated, though using present value table, is calculating assuming that 6 months coupon. Actually, it is annually. Okay, so another question: if Horizon Company's bonds are currently yielding 8% in the marketplace, why is the firm's cost debt lower? The cost of debt is lowering. Why? What is the reason of that? So option A says market interest rates have increased. Additional debt B. Additional debt can be issued more cheaply than the original debt. C. There should be no difference. Cost of debt is the same as the bond's market yield. And D. Interest is deductible for tax purposes. So this is very known fact that we all know, that is interest is deductible for tax purposes. So because interest is deductible for tax purposes, the actual cost of debt capital is the net effect of the interest payment and the offsetting tax deduction. So we can see from a calculation what is the actual effect, actual cost of debt capital, provided that there is an 8% market yield, and still what is that actual cost of debt in this example. For example, the actual cost of debt equals the interest rate times 1 minus the marginal tax rate. Marginal tax rate in, for example, if it is given here, is 40%. Okay, 40% tax bracket. So if you apply that rule, the 8% multiplied by that 1 minus 40%, so it comes to 4.8% only. So actual cost of debt is equal to 4.8%. So that is why this is the firm's cost of debt is becoming lower. So we can see that also here because of the tax rate. So other, like answers A, B and C are incorrect. Okay, because the A says market interest rates have increased. The incorrect, because the tax deduction always causes the market yield rate to be higher than the cost of debt capital. So that is also there. And additional debt can be issued more cheaply than the original debt. Additional debt may or may not be issued more cheaply than the earlier debt, because it depends on the interest rates in the marketplace. So that is not there. Whether it is more cheaper or less or more costly is depending on the market interest rate fluctuation. Okay, not because of the income tax rate. So option D is correct. Measurement of default risk of bonds. Default risk is the risk that the issuing company will default on the bond obligation. This default risk is generally measured by independent analysis performed by financial services companies like Moody's and Standard & Poor's. The rating schemes rank the bond from highest quality to the lowest for the defaults. There are high chances of default if the rating, based on the rating. If the rating is lowest, there are high chances of default. The lower the rating, the higher the interest rate, because the higher the risk, the higher the return expectation also will be there. So the lower the rating, that means the higher the risk. So therefore the expectation of the interest rate also to be higher. So the bond will carry higher interest rate. Based upon ratings, bonds are considered either investment grade, that is high quality bonds, or junk bonds. The investment grade, that is high quality bonds, companies have high capacity to repay and there is little risk of default. The ratings normally AAA, BBB like this, AAA, BBB like that. And junk bonds, these are issued in leveraged buyouts and mergers and are very risky. However, they also carry the potential of very high rewards because they pay a high interest rate. Maybe in the emerging industries, it can be happening. For companies in a difficult financial position, this may be the only source of financing available, and the company will have no choice but to pay the high interest rates on their bonds. So they will issue junk bonds with higher interest rates. Thank you. This is end of the introduction to debt financing, that is bonds, and we have seen all the computation as well. And I have my portal for practicing questions, which will be released once the students confirm that they have completed for chapter A and chapter B up to this part. And then the next lecture will continue about the equity and also the derivatives. Thank you very much. எல்லா புகழும் இறைவனுக்கு.